Hi there. We'll explain how UK bank data sharing works, what income information may reach HMRC, and what taxpayers should understand.
You submit your self-assessment, satisfied that your figures align. Days later, an automated nudge letter arrives on your desk. Or worse, a simple assessment demanding £1,800 in unpaid tax on income you assumed was entirely off the radar. At Pro Tax Accountant, we help businesses navigate the complexities of UK tax planning and compliance. Our role is to map the exact mechanisms HMRC uses to assess your liability, allowing you to build structures that hold up to digital scrutiny. For the director of a UK limited company, the financial landscape is highly specific. You are constantly balancing efficient corporate remuneration with the need to generate and protect personal wealth outside the business. That balancing act now operates under a strict new statutory framework. Under Schedule 23 of the Finance Act 2026, HMRC transitioned from targeted, reactive investigations to a standing data gathering obligation. They now demand continuous, automated feeds of financial data from third-party institutions. This legislation removes the human inspector from the initial equation. Discrepancies between your filed return and your actual financial footprint are calculated and flagged by artificial intelligence, long before an officer ever opens your file. For the modern company director, the assumption that HMRC simply won't know about an account or an asset is mathematically obsolete. The data is already in their system. The first major data pipeline feeding this system is the Bank and Building Society Interest Return, or BBSI. When the Bank of England raised base rates to 5.25%, it collided with a multi-year freeze on tax bands. This combination pushed an estimated 2.7 million taxpayers over their tax-free limits, generating taxable variance on routine cash deposits. This chart illustrates the trap. Basic rate taxpayers receive a £1,000 personal savings allowance. For higher rate taxpayers, it drops to $500. And for additional rate taxpayers, those earning over £125,140, the allowance is zero. This reporting requirement applies to all regulated institutions. Challenger banks like Monzo and Revolut are subject to the exact same statutory data submissions as high street lenders like Barclays or Lloyds. The BBSI data is transmitted directly to HMRC by June 30th each year. It completely bypasses your manual self-assessment input. By October, HMRC systems automatically reconcile this incoming bank data against individual tax records. If the bank reports £3,000 in interest, but your return shows zero, the system automatically issues a simple assessment to collect the variance. Fragmented personal savings spread across multiple apps and accounts are instantly aggregated and taxed, requiring zero manual intervention from HMRC personnel. The second data feed comes directly from the 2025-2026 Close Company Dividend Separation Rules. This mandate impacts roughly 900,000 UK directors. Historically, directors reported a single aggregated figure for all dividend income. HMRC could not distinguish between dividends extracted from a director's own company and those earned through external stock portfolios. As this split flow diagram shows, that single total dividend pool must now be separated out. Directors are legally required to report their owner-managed corporate extractions completely separate from their external portfolio investments. HMRC requires this division so their algorithms can instantly sum up your PAYE salary and your company dividends, mapping the exact total remuneration package of a specific owner-manager. At Pro Tax Accountant, we see many companies failing to anticipate how this data is utilized. HMRC applies this exact split to target their compliance activities with surgical precision. Your corporate extraction strategy is now entirely transparent on the return itself. Profits from your own business can no longer be obscured within a broader list of generic investment income. The third pipeline involves digital assets. On January 1, 2026, the OECD's Crypto Asset Reporting Framework, or CARF, officially goes live. Under this framework, UK reporting crypto asset service providers must record and submit the specific type, exact value, and precise nature of all user crypto transactions directly to HMRC. For high net worth directors, the most consequential mechanism in this legislation is the CARF look-through rule for passive entities. Looking at this network model, holding crypto within a family investment company or a trust used to provide a layer of opacity. Now, the opaque corporate square dissolves. The framework mandates that institutions pierce the corporate veil to expose the specific human beneficiaries behind it. The legal structure is legally compelled to name and report its ultimate controlling persons, the settlers, directors, and beneficiaries, straight to the tax authority. The legacy belief that offshore platforms or complex wrappers guarantee digital tax anonymity is entirely incompatible with the current global reporting standard. Interposing a legal entity does not shield the asset. The wrapper you built to hold the capital is now the exact mechanism required by law to report you. All of these pipelines feed into one central processing core, HMRC Connect. Originally designed by BAE Systems, this is the data matching and risk scoring engine that evaluates your tax profile. Connect continuously ingests over 22 billion lines of data from more than 30 external sources, automatically cross-referencing those third-party seeds against your submitted self-assessment. The trigger mechanism is entirely mathematical. If a director declares 0 crypto gains on their return, but the new CARF feed registers £15,000 in exchange transfers, the engine calculates an instant risk variance. Connect also executes multivariate benchmarking. It compares your declared income against external lifestyle indicators, continuously scanning land registry property data and DVLA records for high-end vehicles that do not mathematically align with your stated cash flow. This is why proper record keeping is vital. Connect does not rely on random human audits. It utilizes statistical models and Benford's law to flag specific structural discrepancies. By the time a human compliance officer actually opens your file, the algorithm has already constructed a comprehensive 360-degree profile of your financial footprint. Ignoring a system-generated nudge letter or concealing data that HMRC already holds carries severe financial penalties. Tax-geared fines for deliberate omissions range from 30% to 100% of the owed amount, compounded by daily interest. Directors must take immediate proactive steps. Verify your PAYE tax codes, maximize legal tax-free wrappers like ISAs and premium bonds, and rigorously reconcile your bank data before filing. If a discrepancy is flagged, this decision tree maps your formal resolution pathways. Errors can be corrected through the Worldwide Disclosure Facility for offshore matters or the Digital Disclosure Service for domestic issues. Initiating a proactive voluntary disclosure through these specific channels heavily mitigates your penalty rate compared to waiting the issue. Please note, this video is for educational purposes, does not constitute formal tax or legal advice, and tax laws are subject to change. To structure your corporate and personal finances with precision, contact Pro Tax Accountant. We provide bespoke tax planning and expert representation to protect you during HMRC compliance checks. Subscribe to the PTA channel to receive ongoing, rigorous analysis of UK tax legislation. In 2026, the only effective defense against an automated, continuous surveillance network is rigorous, proactive compliance, guided by expert strategy.